Hey everyone, welcome back to Corporate Decoder, a place where we decode the hidden meaning behind big company news, and this time we are diving into Cuentas Incorporated's latest quarterly report. And let me tell you, there are some interesting numbers that tell a story about where this company is heading, or maybe where it's struggling to get to. So, what exactly is Cuentas Incorporated? Think of them as a company trying to make it in the world of telecommunications and digital financial services, especially targeting the Hispanic and Latino communities. They have some ambitious plans, but the numbers in this report, which covers their performance up to the 30th of September 2025, paint a picture that needs a close look. Let us start with the balance sheet, which is like a snapshot of what the company owns and owes. As of the 30th of September 2025, Cuentas had very little in cash and cash equivalents. In fact, it was zero. Their total assets were just $271,000. Now for liabilities, they owed a lot more than they owned, with total liabilities at $3,708,000. This means they had a significant negative working capital, over $3 million. This simply means they owe more in the short term than they have in short-term assets to pay those debts. And then there is the stockholders' deficit. This is not a good sign. It means the company owes more to its shareholders, if you could call it that, than its assets are worth. Their deficit here was over $3.4 million. This is a big red flag indicating the company is operating, but its net worth is negative. Now let us look at how they are performing financially over time, the income statement. For the first 9 months of 2025, Cuentas reported zero in total revenues. That's right, no income from sales. This is a massive problem. In the same period last year, they had revenues of $676,000. They also had a gross loss of $84,000 last year. This year, their gross loss is also reported as zero, which is not because they made a profit, but because there were no revenues to even have costs against. Even with no revenue, they still have operating expenses, and these are considerable. In the first 9 months of 2025, their operating loss was $899,000. Last year, it was even higher at $1,645,000. This means they are spending money on running the business, but bringing in nothing. This lack of revenue and ongoing expenses led to a net loss. For the 9 months ended the 30th of September 2025, the net loss was $317,000. While this is less than the $2,916,000 net loss in the same period last year, it is still money lost. The loss. Per share was $0.12 for 2025 compared to $0.98 last year, which looks like an improvement, but it is important to remember that this improvement comes from having no revenue at all. Looking at the statement of changes in stockholders' deficit, we see that the company has been relying on share-based compensation to keep things going, adding $50,000 in value in the first 9 months of 2025. However, their accumulated deficit continues to grow. By the 30th of September 2025, the accumulated deficit reached $58,572,000. This is the total amount of losses accumulated since the company started. Now to the cash flow statement, which tells us how cash is moving in and out of the company. For the 9 months ended the 30th of September 2025, Cuentas used $967,000 in operating activities. This is primarily due to their net loss and changes in their operating assets and liabilities that drained cash. On the investing side, they actually got some cash in. They had $825,000 from the sale of investments in unconsolidated entities. This is a positive sign, a way they are getting some funds. But it is important to note this is from selling off assets, not from their core business operations. Financing activities brought in $127,000, mainly from short-term loans received. This shows they are still borrowing money to keep the lights on. It is concerning that their cash and cash equivalents at the end of the period were zero. This means they had no readily available cash to meet any immediate needs. The notes to the financial statements give us more context. Cuentas is involved in telecommunications, Wi-Fi systems, and is trying to build a joint venture for a mobile virtual network operator, or MVNO business. With World Mobile Group, they are also focusing on their cellular telecommunications solution, Cuentas Mobile. They had a letter of intent with World Mobile back in 2024 and later formed a joint venture. World Mobile contributed capital and Cuentas contributed its MVNO business. This shows a strategic move to partner and leverage external resources, which is smart given their financial situation. This section here, the going concern note, is very important. It states that the financial statements are prepared assuming the company will continue to operate. However, it clearly says that as of the 30th of June 2025, the company had very little cash, negative working capital, and a shareholders deficit. These issues raise serious doubts about whether the company can continue to operate. Their ability to keep going depends on them raising more money through financing and actually generating revenue from their business. Management acknowledges they need substantial additional investments that are not yet secured. This is a classic sign of a company in financial distress. The events during the period are quite telling. Cuentas has been busy settling debts and dealing with legal matters. They settled with Olb Group Inc. and 1800 Diagonal Lending, LSE, paying significant amounts to resolve these obligations. They also sold their interest in Brooksville Development Partners, which brought in $800,000. This sale helped them settle debts with 4 major creditors. This all points to a company actively trying to manage its liabilities and free up some cash, but by selling assets. What is really interesting is the series of convertible notes issued. In September and October of 2025, they issued several convertible notes, including to World Mobile Group, their CEO Shalom Arik Maimon, and others. These notes can be converted into shares of the company's common stock. This means they are essentially taking on debt that could dilute existing shareholders when converted. Some of these notes are secured by the company's fintech division assets. This highlights their effort to raise capital through debt instruments that might eventually convert into equity. They also entered into a distribution agreement for their eSign products. This is an attempt to generate revenue, but it is through a non-exclusive worldwide right to distribute, which is not a guaranteed major income stream. There have been some leadership changes. Michael DePrado resigned as President, Executive Vice Chairman and Chief Financial Officer in October 2025. He received cash and secured promissory notes as part of his separation. This is another indicator of financial strain, as large payouts for executive departures can be burdensome. They also saw changes in their CFO position, with a new interim CFO appointed. In a significant development, Cuentas entered into an engagement letter with Maxim Group LLC, a financial firm, to manage a potential follow-on public offering of their common stock and warrants. This means they are trying to raise more money by selling more shares to the public. Maxim is their exclusive managing underwriter and book running manager. This is a common strategy for struggling companies trying to raise capital, but it comes with fees and potential dilution for existing shareholders. Looking at related party transactions, it is notable that they had zero revenue from SDI Cuentas LLC in the first 9 months of 2025, compared to $81,000 last year. Also, cost of sales from Next Communications Incorporated, a company controlled by their chairman and CEO, was zero this year compared to $565,000 last year. This suggests a significant shift or cessation of business with these related parties. In terms of segment performance, the company reported zero revenue across all its product categories for the 9 months ended the 30th of September, 2025. This is a continuation of the trend from the 3 months ended the 30th of September, 2024, where revenue was also minimal or zero. This really underscores the critical lack of revenue generation from their core business segments. Their total gross loss for the 9 months ended the 30th of September 2025 is reported as zero, which, as we saw earlier, is due to zero revenues. Last year, they had a gross loss of $84,000. This highlights that the absence of revenue while eliminating gross loss figures is not a sign of health, but a symptom of a stalled business. Operating expenses, particularly selling, general, and administrative expenses, remain a concern. For the first 9 months of 2025, these expenses totaled $899,000, a decrease from $1,542,000 last year. However, a significant portion of this decrease comes from a substantial drop in professional services and legal fee spending, and a sharp increase in officer compensation. This is something to watch closely, as rising executive pay while revenue is absent can be a red flag. The company incurred a net loss of $317,000 for the 9 months, ended the 30th of September 2025. This improved compared to the same period last year, but again, the improvement is largely due to the severe reduction in activities and revenue. The liquidity section really drives home the precariousness of their financial situation. As of the 30th of September 2025, they had $0 in cash and cash equivalents, a working capital deficit of $3,437,000, and an accumulated deficit of nearly $59 million. The report explicitly states that these conditions raise substantial doubt about the company's ability to continue as a going concern. They are banking on securing additional financing, which is not guaranteed. Operating activities have consistently drained cash, using $967,000 in the first 9 months of 2025. This outflow is driven by their net loss and a significant negative impact from changes in operating assets and liabilities. The inflow from investing activities, $825,000 from selling investments, was crucial in cushioning the blow of negative operating cash flows. Financing activities provided $127,000. This shows an ongoing reliance on debt and other financing measures to stay afloat. The issuance of convertible notes, as mentioned before, is a key part of their financing strategy. They state they have no off-balance sheet arrangements, which is generally a good thing, meaning there are no hidden liabilities lurking outside their main financial statements. This report also includes a section on controls and procedures, and it's not glowing. The Chief Financial Officer has concluded that disclosure controls and procedures are not effective. This means there is not enough assurance that information required to be disclosed is properly recorded, processed, and reported on time. This is a significant internal control weakness. The legal proceedings section reveals a significant ongoing matter concerning alleged avoidable transfers from Cuentas Inc. to Cuentas. The company has accrued $300,000 as of the 30th of September 2025 due to this matter. While Cuentas denies liability and has an indemnification from a related party, the possibility of an adverse judgment or settlement means there is a potential financial impact. The risk factors section, not detailed in this report but referenced from their previous filings, would certainly include their lack of revenue, negative working capital, and going concern issues. These are the most significant risks facing the company. It is good to see that there are no defaults upon senior debt, but this is likely because they have very little senior debt and are relying on other forms of financing. The exhibits section lists numerous agreements and filings showing a lot of activity. This includes the formation of their joint ventures, settlement agreements, and financing documents, all of which point to a company in the process of restructuring and seeking new avenues for growth and capital. So, what is my take on Cuentas Incorporated? This company is in a very challenging position. Their core business is not generating any revenue, which is the most fundamental problem any business faces. They are relying heavily on asset sales and borrowing to stay operational, and they have issued a significant amount of debt that could convert to equity, diluting current shareholders. The positive notes about strategic partnerships and efforts to settle debts are commendable, but they don't mask the dire financial reality. The fact that management itself states there is substantial doubt about their ability to continue as a going concern, and that their disclosure controls are not effective, paints a very grim picture. There are opportunities in their joint ventures and focus on underserved markets, but their ability to capitalize on these is severely hindered by their current financial state. Unless they can significantly ramp up revenue generation or secure substantial sustainable funding, their future looks very uncertain. Alright? That's our deep dive into Cuentas Incorporated's latest report. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out our Discord community, linked in the description. Thanks for watching. See you next time.